Welcome to The Explainer. I am absolutely thrilled to guide you through today's topic. We are diving into the evolution of the financial mind, specifically how AI is completely rewriting the rules of the market. We're going on a journey to uncover how artificial intelligence went from clunky, rigid software to the dynamic, predictive agents that are literally running the modern market. If you want to know where the big money is moving, you've got to understand the mind directing it. So let's get right into it.
Here is the ultimate question we have to ask ourselves. Can an algorithm actually understand the market better than a human? Can a machine really grasp the complexities of finance, the sudden market panics, the subtle hints buried in a corporate earnings report better than a seasoned Wall Street analyst? For decades, the answer was a flat no. Computers could crunch the numbers, sure, but they couldn't actually think. But recently, the architecture of machine intelligence went through a massive transformation, and it has absolutely changed the financial world forever.
Which brings us to Section 1, the AI paradigm shift.
To really understand this shift, we need to look at the rule versus pattern analogy. Back in the early days, we relied on what was called symbolic AI. Basically, if you wanted the computer to do something smart, a human programmer had to literally sit down and hard-code procedural logic rules for every single possible scenario. It was incredibly rigid. But then, researchers flipped the script. They stopped trying to program procedurally and started tackling intelligence empirically. And boom, connectionist AI, or what we know as modern machine learning, was born. Instead of feeding the computer rigid rules, we now feed it massive datasets, and it discovers the complex patterns entirely on its own.
You can really see how restrictive that older era was when you look at early financial consultant programs. They relied entirely on hard-coded rules, written out as logic predicates. Think about it. A programmer had to manually type out line-by-line conditions just to decide if an investor should open a savings account or buy stocks based on their income and dependence. If a specific scenario wasn't explicitly coded into those mathematical rules, the system would just fail. It was kind of like trying to navigate the ocean with a map drawn on a napkin.
Now contrast that clunky manual coding with modern neural networks. Instead of a human sweating over if-then statements, deep learning ingests massive, unstructured streams of data. The system automatically maps out complex structures and hidden patterns. It doesn't need us to tell it how to spot a good investment. It learns what a winner looks like by analyzing millions of past examples. This huge leap from procedural coding to empirical learning is exactly what makes today's financial AI so incredibly powerful.
Let's move on to Section 2, Econometrics versus machine learning.
If we break down data analysis, it generally falls into 4 buckets: prediction, summarization, estimation, and hypothesis testing. Traditionally, econometricians and statisticians are laser-focused on those bottom 2, extracting insights and validating theories to understand why something is happening. But machine learning, it brings all its firepower right to the top category: prediction. Machine learning specialists aren't always losing sleep over explaining the underlying economic theory. Instead, they're building high-performance systems designed to give us highly accurate forecasts under chaotic, real-world conditions.
The crucial takeaway here is that machine learning solves this prediction problem by estimating functions to uncover generalizable patterns without just memorizing or overfitting the data. Think about facial recognition. Modern algorithms aren't using hardwired rules about what a nose or an eye looks like. They just ingest thousands of photos labeled face or no face, and they learn the empirical pattern on their own. And we are now applying that exact same logic to financial markets. The algorithm doesn't need a PhD in inflation theory to predict how a stock will react to it. It just recognizes the pattern.
Let's see how this plays out in Section 3, reading the market's language.
This is where natural language processing in finance gets genuinely mind-blowing. AI is no longer just staring at spreadsheets. Researchers are using algorithms to categorize 1.5 million online financial message board posts, literally classifying them as bullish or bearish just to predict stock market volatility. Or take corporate 10K filings. Economists are using AI to read these massive, dense business descriptions to map out hidden similarities between different industries. There are even algorithms scanning Yelp reviews to predict the outcomes of restaurant health inspections. It's wild. AI processes all this unstructured text to pull out predictive financial signals that a human analyst would completely miss.
Which brings us to the bleeding edge in Section 4, the rise of trading agents.
We are currently watching the market get reshaped by large language models acting as autonomous agents. Just look at some of these new frameworks. You've got Kronos, which is a foundation model pre-trained specifically on financial K-line data, and it's already outperforming older models in market forecasting. Then there's trading agents.
This is an incredible multi-agent framework that literally simulates a real-world trading firm. It has multiple AI agents collaborating, debating, and significantly boosting cumulative returns. And finally, AI Trader, which acts as a fully automated live benchmark to evaluate how these LLMs make real-time decisions across different markets. We aren't just building tools anymore, we're literally spinning up synthetic trading firms.
And of course, there's a defensive side to all this. Section 5, Securing the Financial Vault.
So how are institutions using this predictive power to defend themselves? It happens in real time. Step 1 is the continuous, millisecond by millisecond analysis of massive volumes of financial transactions. Step 2 is bringing in an AI model trained specifically to spot behavioral anomalies. Honestly, it knows your standard purchasing habits better than you do. So the very second a transaction deviates from your normal pattern, it flags it. Which leads right into Step 3, an automatic trigger that notifies security teams or even blocks the transaction instantly. It stops fraud dead in its tracks with zero human intervention required. It's basically an invisible, self-adapting shield around your money.
But all this autonomy definitely leaves us with a profound question. I want to leave you with this quote from the OECD regarding the risks of this black box technology. They point out that doing this autonomously by self-learning AI without building on an explicit economic model makes collusive outcomes possible even without the explicit intervention of humans. Think about what that means. If these algorithms are highly autonomous, constantly self-improving, and optimizing purely for profit, without actually understanding human economics, they could theoretically learn to collude and manipulate prices all on their own. So, what happens when self-learning machines eventually run the entire market, operating in ways we literally can no longer decode? It's a fascinating and maybe slightly terrifying thought to end on. Thanks for joining me for this explainer, and I hope it completely changes how you view the invisible minds operating behind the scenes.